I've invested in over $10 million worth of real estate using different strategies, and in this video, I'm going to rank them based on risk versus return, so you'll know exactly which strategies have the highest potential for making money. And by the end of the video, I'm going to share which strategy I use the most and why. So we're going to start with the tier list, and F is the very bottom, which is actually management. So management isn't technically an investment strategy, but it is a way that you can get started and gaining skill. So what do I mean by that? Well, you have to actually figure out how to rent to tenants. So that would be property management, technically. How you can deal with tenant problems, how you can deal with property problems. So the other types of management would be renovation management, financial management. For me, my first-hand experience with management got my foot in the door behind a big portfolio, and it was doing all the tenant re-rentals, dealing with tenant problems, managing contractors on job sites for renovations. So I really do believe that this is a great starting point for gaining skill. But when it comes to real estate investing, it's going to be an F tier because, well, you're not actually buying property and investing in real estate technically, but it's a good foundational step for gaining that skill. And so if you want to up the ante of skill, we're going to go up to the C tier. So the C tier is going to be what we call professions. And professions would be like a realtor, a property appraiser. It would also be like a mortgage broker. So these are going to be people that actually get licensed in the industry. So you're not buying again real estate, but hey, you're gaining good credibility. Like if you're a realtor, mortgage broker, property appraiser, you have like a license, it gives you credibility early on in the game of real estate, which can help you later on going up the tiers. So B is wholesaling. So wholesaling is when you're going to be finding property deals. Usually they're like really discounted, because what you got to do with wholesaling is you find a discounted property where you can make enough money and the end buyer that you're assigning the agreement of purchase and sale to can also make some money. So there has to be enough meat on the bone that both parties can make money from a deal. So usually buying things for 20, 30% off when you're wholesaling. It's really hard to do though. The internet, like on YouTube, makes it seem way easier than it really is. So you have to get good though at finding deals if you want to play the game of real estate investing. So that's the advantage of wholesaling. You can do a $5,000, $10,000, $15,000 wholesale fee. That's also what I did later on after managing properties, was I started wholesaling a little bit. The challenge though is, again, you have to take a long time to really figure out how to find good discounted deals. So now that we've covered the B tier being wholesaling, we're going to actually get into buying property. So this is really just finding deals, but you're not buying them and holding on to them. But flipping is when you're actually going to start buying property, financing them. So you're going to learn how to finance them, find good deals, finance them, and then also find contractors and manage those contractors. So for flipping, I find like when I started flipping, I did quite a few flips. You can make serious money in like a matter of 3 to 6 months, like 25, 50, even 75,000. Some of my flips made 100 grand. So you can profit a lot of money here. Whereas wholesaling, you're kind of making a $5,000, $10,000, $15,000 wholesale fee. They can make you a lot of money, like if you know what you're doing. It just takes a little bit of time to really gain that skill. So you can kind of start working way up here to gain that active income skill, and you can also make some money, right? This could be $25 an hour, $30 an hour, an 8% property management fee. This can be more like, you know, like realtors in the US can make 100 grand on average. Like that's a pretty decent average salary, right? But again, you're just gaining more knowledge and skill and income here. But as you're going up into the S tier, which is going to be your superior tier, this is where you're actually starting to build wealth. This is more active income, if that makes sense, right? Because you're not holding on to these properties for long. So the superior tier is what everyone's really after in my mind. I've spoken to hundreds of investors and everyone wants to buy and hold. So you can buy and hold onto the property for at least 5 years. That's like the minimal in my mind. Like most people want to hold on to them for 10, 20 years because there's like this really great relationship with the amortization table. I'm not going to explain that a whole lot today, but there's interest and principal, inverse relationship. So you're every single mortgage payment paying down more principal and paying less interest, which is a good thing. So you want to hold on to it for a long period of time. The other huge advantage is when the market appreciates year over year, there's a compounding effect that happens, and that's how you get really wealthy and rich through real estate. So if you have 10 million bucks in real estate and it appreciates 10% in a year, you made $1 million without lifting a finger. It's pretty good. So this is where you're really wanting to get to, usually as you're doing real estate investing, is building up the momentum of skill and money so you can do more buy and hold. So now within buy and hold, there's going to be a few different decisions you have to make because there's a lot of different strategies that you can use within buy and hold. So that brings us into the next main framework, which is going to be your risk versus reward of the different types of strategies within buy and hold. So there's three main decisions that you have to make. The first one is going to be the length of tenancy. The traditional length of tenancy is like a 12-month lease, right? Like those are your classic tenants. So you have 12-month leases, and then you have medium-term rentals. So a medium-term rental would be like, usually it's at least 1 month, but it could go up to even like kind of 11 months, right? It's in the middle. So this is going to be risk versus reward right around here. It's kind of moderate risk versus reward. Like I started with the long-term rentals, and it's very stable because even during a recessionary period, people still need a place to live. Medium-term rentals could be like a furnished rental. You can get more of a premium on it. There's certain marketplaces that are really, really good. Like if C-level executives come in, medium-term rentals can really crush and your reward can be even higher. But also like there might not be a demand for medium terms that are furnished rentals. So that's kind of why I'm putting it right around here. So I've had some really great experiences with long-term rentals, tenants that are just very hands-off and passive, and they text you like once every 6 months, which is great. But the other alternative option for your length of tenancy is a short-term rental. So for short-term rentals, they're a lot more active. Like you could get a message every single day or a couple times a day. I've been out for lunches and dinners with friends, and I get like a Airbnb guest that messages me. So the risk is going to be slightly higher. It's going to be up over in here because it's more active and more complex. So you have guest communication, you have cleaning to deal with, you have maintenance, that's even more than a long-term rental. You also have price optimization, the average nightly rate changes as well. So there's a little bit more complexity. Replenishables like hand soap, paper towels, stuff like that. But if you do it really well, the reward can be quite a bit higher. As an example, for a long-term rental, I might get $100 to $200 per month per unit in cash flow. Whereas a short-term rental, I could get like even $1,000 per month per unit in cash flow. So the difference there is quite extreme, but the risk is also higher if you don't know what you're doing. So in the video, I'm kind of pretending right now like you're a blank canvas, no experience, and you're not really sure what to do, but you can mitigate the risk if you know what you're doing. Hopefully that makes sense. So the deciding factor between long-term, medium-term versus short-term in my mind is how much time do you have to actually put into it to learn it and then also to do it. So I would say from my own experience, long-term rentals, you can get away with doing a longer or medium-term rental for less than 5 hours a month. So if I had like a fourplex or something, maybe less than 5 hours a month is all I'd need, really as an example. Whereas a short-term rental, I usually need quite a bit more than 5 hours a month, even if you have some people in place and you have good systems in place. If you don't and you're doing the cleaning and the guest communication, the price optimization and all the other things, it could be 5 hours a week. So just bear that in mind if you're looking to get into the short-term rentals. It's a lot more time intensive. Now, the next decision you should look to make when you're doing buy and hold investment strategies is the state of the property. So what do I mean by the state of the property? Well, when you're buying it, what's the condition? So you have what's called a turnkey property. And so turnkey is already optimized. You have tenants in place, they're at fair market rent. You likely have management already in place. There's not a whole lot of like distressed issues with the property. It's in decent shape. Turnkey is going to go right here. We're going to put it super low risk and super low reward. You know, like people can do it. Like this is just a normal thing to do is like go and buy a turnkey property. Like that's usually where people start. Most of what's on like realtor.ca or .com for listings are going to be turnkey. Though the goal is that you can go and you can buy a property a lot of the time and fix it up. So that's what I did, and that's how we've done 10 million and 16 rentals is we buy a property that's worth say 400,000, put 50,000 into it, strategically renovate it, and now it's worth say 550 or even maybe more than that. So we get a lift. Where you can go wrong though is if you do a fixer-upper and you put say 50,000 into it and the property's value only goes up 50,000, you might as well have just done a turnkey property. It's about the same thing. So I'm gonna put the risk and the reward right here for a fixer-upper. It is riskier than a turnkey, quite a bit riskier if you don't know what you're doing. Because you could put 50,000 into it and the value only went up 25 grand, you just lost 25,000. You can also over renovate, and that's the challenge, is figuring out what to renovate and what not to renovate. Now time-wise, how do you make the decision? I'm gonna say the same thing. If you have less than 5 hours a month, I would definitely settle on a turnkey property. If you have more than 5 hours a month, I would look at some fixer-uppers, but again, this can be way more time intensive. There was a point where we did 3 to 5 renovations at any point in time for fixer-upper properties. And I was out like 15, 20 hours a week finding contractors and managing those teams. It can be almost a job in and of itself. And so the final decision you have to make when you're looking to do buy and hold strategies is the size of the property. So this is probably the most common question I get is like, when should I get into the bigger stuff? And so I'm gonna answer that right now for you. The first decision you have to make again is the length of tenancy, then the state of the property, and the third is the size. So you have residential properties, which would be single units. What are single units? Single family homes, mobile homes, townhouses, condos. These are all pretty easy to get into, and they're not super overly priced, but there is actually an element of risk when you have a single tenant covering all of your expenses like mortgage, tax, insurance. Because if they stop paying the rent, well, you're on the hook for all of the expenses. But residential also, people kind of forget about this one, have multi-family property, which would be duplexes, triplexes, and fourplexes. That's where I started, and I really like these types of properties because the reward can be more, and it mitigates your risk too. Because, well, if one tenant stops paying your rent in a fourplex, you still have 3 others to help cover the expenses. So residential is a really good starting point. And if you want to level up though, you can into a bigger size property, which would be commercial. And commercial properties are much more complex, therefore providing a lot more risk than residential. There's really 9 types of commercial. I speak about that in a different video, so you can check that out if you want. In commercial, there can be a lot more reward though, like one commercial property done well, and you can be financially free. So commercial would be like a 5-unit building or larger. So an apartment building, you have retail, hospitality, so hotels, motels, and inns. There's a whole bunch in there. And again, like if you don't know what you're doing, then the risk is super high and it can be game over if you screw it up. So you want to be careful if you're doing commercial. My deciding factor when I'm working with clients at rentalconsulting.com in terms of like what they decide to do, whether residential or commercial, is how much do they have saved and how much time do they have? So it's really those two. I would say if you have less than $100,000 saved, definitely just stick with residential in my own opinion, because it's gonna be hard to get into a commercial property with less than 100 grand. If you have more than 100,000, I would start shopping and looking around in the commercial space. You might not be ready yet. And I would also make sure you have at least 5 hours per month set aside if you want to do a commercial property. So those are the 3 main decisions that you have to make when you're navigating which buy and hold strategies that you want to go ahead with. So hopefully you got some value from this video. There's another video over here if you want to go check it out, where it explains how we went from 0 to 16 properties in just a couple years. And don't forget to subscribe to the channel. We'll see you on the next one.